Here we go now. Good afternoon, Orlando, and welcome. My name is Geoffrey Gallo. I'm Senior Vice President of Sales and Strategic Consulting here at CPA firm Grennan Fender here in Orlando, and I'm your host for the next 60 minutes or so with the stated purposes of informing you of what we know as of today regarding all aspects of the PPP, but we'll continue to send out correspondence as more clarity is provided by the SBA, IRS, and U.S. Treasury. Secondly, inspiring you. We're going to share some insights, stories, experiences we have witnessed over the past 8 weeks, some of the things that we picked up from our clients. Thirdly, connecting you with the panelists in a relaxed conversation. We're going to be covering a lot of material, folks, so bear with us. And then encouraging you, and that the proverbial light at the end of the tunnel is not a train, and we can both survive and prosper. So for those of you who do not know us as well, we are one of the largest original founder CPA firms in Central Florida, and according to the Orlando Business Journal, we're the 15th largest CPA firm in the area. We have 41 staff professionals between 2 locations here and in Melbourne. And in 2019, we were basically awarded the Reader's Choice Award as the best Orlando accounting firm, and something that we are very, very proud of. And we are a full service company covering everything from the consulting to the assurance and tax and outsourced accounting. So we try to cover it all. We're an entrepreneurial shop. Number of business leaders have very practical experience, not just accounting, but in business to better serve you. Next, I just want to give a disclaimer for all the attorneys out there. We offer this, that it is our intention to provide information as accurately as possible, but just given the speed and fluidity of current events, the speaker's comments represent our best interpretations of the new laws as we know them to be. Future government rulings and interpretations could change and potentially affect your own situations. Just please continue to keep track of these things. We are sending out a lot of information via our email blasts and our webinars. So stay with us on this. Okay, just a few housekeeping pieces. After this program, a follow-up email, as we have been doing over the last 7 weeks, is going to be sent to you after this webinar, and you'll have an experience survey. We'd love your feedback, as well as we're going to send a video recording of the program. Of course, feel free to submit any questions you have during the webinar into the Q&A box. We received probably 4 dozen questions in advance of this, and so we have proactively tried to gather as much information in the form of a case study, which Jed is going to handle at the end of the PowerPoint presentation. As best we can, we're going to create a Q&A document from what we heard here today, all the questions and the answers, and send them out to you as well. And of course, stay tuned for future webinar on hot topics. We have one scheduled for a few weeks from now, and more details are to follow. Okay, so here are our speakers. Let's speak to Jed Grennan. Has been in practice for nearly 40 years. He is one of the co-founders of the organization with more than 35 years experience serving the small and mid-sized business community here in Central Florida. And he is also a Florida Gator alum, so don't hold it against him. Agnes Gregory, tax partner, over 17 years, serving larger second and third stage companies, largely manufacturing, construction, as well as a lot of experience in the M&A advisory world. And she is a graduate of the University of Central Florida. Go Golden Knights. All right, so here we go. The first thing that we're going to do is ask a polling question, and we have been doing this to great success because it really sets everybody up. And the first one is, where are you in the loan process? So I'm going to launch this right now, and everybody should see it on their screen. And I will be getting real-time feedback from all of you, and I will feed it back to our panel so that they will have an understanding of where this is. The answers are, I have not yet applied. I have applied, but waiting for approval. Have been approved, but waiting on funding. I have received my full loan proceeds, And lastly, I have received loan proceeds, but less than applied for. And I'm going to give around 40 seconds. We have another 8 seconds to go. And about 80% of our audience has voted. So that is very, very cool. And here we go. We're going to end the polling. And panelists, can you see that information? So, so here we have the largest share is 84% of you out there have received your full loan proceeds, followed by I've been approved but waiting on funding. That's 8%. I've received loan proceeds but less than applied for. That's 5%. 2% was I have applied but waiting for approval, and then 3% I have not applied. So that is terrific. There are the results, folks, which now we have a follow-up question, all right? And that is, what part of the PPP loan is giving you the most concern? All right, so I'm gonna jump in here and get the next one. So bear with me 1 second. Let's see if I can get this right. Polls, and I'm going to stop share these results and get into the second one here. Okay, here we go. What part of the PPP loan process is giving you the most concern? Multiple choice questions: our ability to spend the money within the 8-week period, meeting the 75% payroll cost requirement, sustaining your full-time equivalent ratio for maximum forgiveness, record keeping for the SBA is the fourth one, and I've got a fifth one in there that I can't quite read for some reason because it cut me off. But we have 30 seconds here, and we got 10 more seconds before I share all of those results. Okay, we got about 65% so far completing that. Oh, they're coming in fast and furious. Okay, so I am ending the polling and sharing these results. And here we are. Basically, half of you said that record keeping for the SBA is a major concern. And that's followed by sustaining your full-time equivalent ratio for maximum forgiveness. Then the ability to spend the money within the 8-week period, 22% of you said that. Followed by meeting the 75% payroll cost requirement. That was another 14% of you. And the last was limited response from my advisors. So I'm scared. That is a scary thought. That is really, really something. All right, so I'm going to stop this piece, and we're going to get into this next one here. Optimizing loan forgiveness and qualifying expenses. And my friend Agnes Gregory is going to pick up from here. Agnes.
Thank you, Jeff. Thank you, everybody, for joining us. We're going to go into a little bit more detail with the calculations and what some of these expenses mean in the rest of the slides, and Jeff's going to have some examples for us. So right now we'll go through just the overall definition. Payroll costs, what that means is gross salaries, and it literally means just that. It's not the amounts from your taxable wages or your box 1 W-2 wages. It's the gross salaries for your employees without accounting for the amount of the Social Security limits or anything like that. It is limited to the first $100,000 of salaries, and we will have an example on that as well. There's a limitation on that and how that affects each of the pay periods for the next 8 weeks. State unemployment taxes will count as part of payroll costs. Any other taxes such as Social Security and Medicare will not count. Health insurance premiums, vision and dental are typically the ones that count for this type of expenses, and it is only the amount that the employer itself pays. Employer contributions to retirement plans will also count. These contributions need to be paid during the period, just keep that in mind. And then also partner distributions that are subject to self-employment tax. So each partner, if you happen to have a partnership as your entity, cannot apply for his or her own loan. It has to be done through the entity itself, and those payments made to the partners will count as part of the payroll expenses. What will not count are 1099 contractor employees. Each of those employees or independent contractors should be applying for their own PPP loans and funding. Here is an example for the proration of the excess wages over $100,000. It is prorated to each pay period. So when we're looking at gross wages, if there's a salary amount or bonus amount or anything that if you were to annualize that pay period's wages ends up being more than $100,000, then there's going to be a reduction to how much of that expense you can use against the forgiveness of the PPP debt. And basically for a twice a month payroll period, the limit is $4,167 of any kind of wages, whether it includes bonuses or whatnot. That's the limit. Anything over that will be a reduction in the amount that you're able to use towards the loan forgiveness. Qualifying expenses, rent. Rent is definitely a qualifying expense. As far as the guidance is concerned, real property and personal property rent will count as long as you have the agreement in place before February 15th, 2020. Anything that's new or recent taken out after that date will not count towards this type of expense. Interest on mortgages and notes payable, same thing. The agreement has to be in place by February 15th, 2020. We have not received guidance on whether related party loans will count towards the forgiveness. The guidance does say that it is mortgage type of expenses, which typically means that the mortgage has to be secured by the property of the entity. Hopefully there will be guidance that comes out to state more information on this issue. Utilities, there are very specific utilities that are eligible for this expense category. It's electric, water, gas, internet, telephone, and there is actually one more, it's transportation. The guidance has not come out on what that particularly, what do they mean by transportation. And the same thing with gas is actually for utilities to the, it's for utilities to the business. It's not necessarily gas for the vehicles. However, if the transportation cost includes gas, hopefully they'll come out with more guidance on that and we can confirm that. As of right now, we do not have that guidance, but it's the traditional utilities that they're looking for right now.
Okay, let's get into the things that limit your forgiveness amount. There's a hierarchy of forgiveness. This is not in the act, but this is what most people are saying, that the first thing you have to do is you have to spend the money the way they want you to spend the money, and that's what Agnes just went over. The second limitation is you have to maintain your full-time equivalent employees during the covered period, which is the 8-week period, based on a previous period of your choice. The second reduction is that if you have employees whose compensation has been reduced below 75%, then that reduction amount will also reduce your forgivable amount. And then lastly, you must expend the PPP proceeds on payroll costs to a minimum of 75% of the loan amount. If you don't, that is the final reduction in your forgivable amount. So what is a full-time equivalent? There's no definition yet on what is a full-time equivalent. Everybody seems to be turning towards the IRS regulations, which says someone who works 30 hours a week is considered a full-time equivalent. The denominator is going to be something you can choose, and you want to choose the one that is lower, obviously. You have a choice of going back from February 15th, 2019 to June 30th, 2019 and using the full-time equivalents per month during that period. Or if it's more advantageous to you, you can use the average number of FTEs per month from January 1st, 2020 through February 29th, 2020. However, if you're a seasonal employer, you have to use the period in the 19 period, the 2015 through June 30th of 19. The key thing to know is that the FTEs are based on your monthly average. And within each month, the FTEs are based on pay periods during that month. So if you have 2 pay periods during the month of May, then you would figure out your FTEs for those 2 pay periods, add them together, and divide by 2, and that would be your FTEs for the month of May.
Well, Jed, I just want to mention that we have a flurry of questions that are flying through both the chat box and the Q&A, and I just want to ask everyone to be patient because we're going to have a fairly detailed example at towards the end of this PowerPoint, and we will have certainly time for individual addressing of your questions. So hang in there with us, okay?
So here's a quick little example of calculating the FTEs per pay period. So in this example, we have 10 full-time employees working a minimum 30 hours, and we have 6 part-time employees working a combined 90 hours per week. So you could see that if your pay period is weekly, you would have 100 or 390 hours of qualifying hours. Remember that a full-time employee, you only count up to 30 hours, no more. So at 390 divided by 30 gives me 13 full-time equivalents, and so on and so forth. If it's bi-weekly, we double that. If it's semi-monthly, it's 845. Our divisor would be 65, which gives us 13. So no matter what your pay period, if you have the same employee number, you should arrive at the same full-time equivalents per pay period. The second limitation on your forgiveness amount is if you don't maintain the compensation levels, and this is on a per employee basis. So every employee needs to be measured for this calculation. It's not an aggregate calculation, it's a per employee calculation. So you must maintain each employee's compensation at a level of 75% of what they were paid for the prior full quarter compensation they received. There is one exception. The exception is if an employee's annualized salary exceeded $100,000 during a single pay period in 19, those employees are not calculated for this reduction. And the key there is that you could have an employee whose annual compensation before bonuses is less than 100. But if they have a pay period that includes a bonus, that if you multiply their regular pay plus their bonus times the number of pay periods in a year, you may come up with more than $100,000 for that employee. And if you do, that employee is excluded from this 75% threshold calculation. So here's an example. In this payroll, we have 7 employees. You can see that employee A, C, and F all make over $100,000, so we don't even have to include them. The other employees, we need to calculate to see if their salaries have been reduced. So if you focus on employee G, you could see that his salary, we needed to target 75% of his annual pay during that covered period, which is your 8-week period. And 75% of that pay is $12,188. However, in this case, we only paid them $3,250 during that period, which is a reduction of 48% below the 75 amount. So you would take that 48% times what you paid them, and you would reduce your forgivable amount by that number, which in this case is $1,571. So the key there is it's per employee. And the other thing to keep in mind is that if you have a bonus period, you may want to go see if that person can be excluded, because with their bonus for that pay period, they may be over the $100,000 threshold. You know, the last thing that, and this is one that it's not very clear and we're waiting for better guidance. What we've heard in the market is that they believe that this part of the CARES Act is going to be amended or adjusted, but basically they have this one catch-all that says if you restore your full-time equivalents and increase the pay back to what they were for the prior to the 8-week period by June 30th, then the other tests become irrelevant. I would not bet on that being the case. I believe the act will actually not give you that out because there's way too many games, especially that us accountants can play, to meet that threshold and not worry about meeting the other two calculations. So although this is in the law, at this point, it's very, very unclear, and I would not bet the house that as long as you get everybody back on payroll by June 30th at their prior salaries, you'll be okay. Self-employed individuals are a different animal, and some of you may be in this category. You know, the key is that the amount of the loan is going to be based on your 2019 net profits from Schedule C. And that loan amount is based on 10 average weeks of self-employment, which is simply 10 50-seconds of your net income reported on your 2019 Schedule C. The trick here is that the forgivable amount is based on 8 50-seconds times your net profit. So obviously, if it's based surely on those two calculations, you're going to have 2 weeks of uncovered loan proceeds that need to be repaid. The key is that if you have other qualifying expenses to apply towards those last 2 weeks, then maybe you can have 100% of your loan forgiven. And those other deductions are interest, rents, utilities. There is a caveat, is that those expenses either must have been claimed or could have been claimed on your 2019 Schedule C. So here's a quick example for self-employed individuals. Let's assume that your 2019 net self-employment income was $84,000. You would divide by 12 to come up with your monthly average net income and multiply by 2.5, and that is your maximum PPP loan amount of $17,500. Now you could see that the forgiveness amount is based on 8 weeks. So the same net income divided by 52 times 8 only gives you what they call the owner's compensation replacement at $12,923. So you've got a gap of $4,575 that need to be covered by those other expenses. One thing to take into consideration, that health insurance premiums and contributions to retirement plans are not qualifying expenses for a self-employed individual.
Let me just take one step back and talk about what Jed just talked about with self-employment individuals, that there's a gap between the funding amount and the actual expenses that a self-employment individual has that's eligible for forgiveness. The way that the formulas are currently written for the forgiveness, that's actually the case with traditional businesses as well that have employees. So the way that the formulas are written, there's a good chance that unless your salaries and your payroll compensation is actually going up, there's a good chance that a portion of your loan is actually not going to be forgiven. Mathematically, that's what the numbers look like. From what I've seen, I think the amount is about 1.5%, just because the loan amount that you were granted was based on a monthly calculation. And the numbers that we're looking at now for the forgiveness are actually based on a weekly compensation. So the formula just doesn't work. We're hopefully going to get some guidance from the Treasury on what they intended. And part of the deferral that they did with pushing back the requirement for unemployment to May 14th was that the Treasury is supposed to issue guidance by then. So hopefully in the next couple of days, we have more guidance on how these numbers are supposed to work. But as of right now, it's still unclear. So going back to my slide with the forgiveness amount, what happens if it's all not forgiven? There is a 1% interest that starts accruing from the date of funding. There is an unforgivable portion to the loan, then that has to be repaid within 2 years. There will be some unforgiven portion for most businesses just because of the loan interest that's being accrued. That's not something that's forgivable. So you will have to pay back that interest amount no matter what. And then if there's anything else that's not forgiven due to the calculations and where your numbers end up, then that amount has to be spread out over the next 2 years as well. There is no prepayment penalty if you do choose to repay the loan early. And the installments don't have to begin until month 7 after the loan date. However, as we mentioned, interest continues to accrue. So it's a low interest, so that's nice, but it does continue to accrue. Record keeping requirements for the loan. What the banks are going to be looking for and what the SBA is really looking for with these record keeping requirements is the proof for those factors that Jed went through already. So they're going to be looking at reports and anything that you can show that shows the number of your full-time equivalents, and you can prove where you're at with that. They're going to be looking at individual payroll records to make sure that each individual employee's pay did not drop more than 75%. And then they're going to look at the overall cost that you have expanded to make sure you're meeting that 75% payroll threshold that they set, as well as making sure that you have proof for the other expenses that you're including into the forgiveness calculation. So they're going to require payroll reports, 941s, any kind of the payroll reporting tax forms. They also will require you to prove that you made those payments. So on top of just being able to provide reports, you will need to provide things like canceled checks or wire instructions or something to prove that the payments were actually made within that time frame. And I do believe we went over this at some point in the presentation. There is a vagueness in the law whether or not the expenses have to be done in a cash or accrual basis. And that's in there right now. We don't really have a whole lot of guidance, but the law specifically states that expenses that were incurred as well as paid within the 8-week period is the only expenses that count. So we have no guidance yet as to whether that means that if you get funding on May 1st and you have a payroll on May 2nd that covers the period before May 1st, are all those expenses eligible for the loans? We don't know yet. So that's something that we're looking for guidance from the Treasury on. Hopefully we'll get that soon. But it is very clear that whatever the expenses that you are going to be using towards loan forgiveness, they have to be paid within the 8 weeks. We just don't know if the incurred piece of it is also applicable or not.
Got it. Hey, I'm just going to step back. We have several dozen questions that are flying in here, but just on your prior slide, Agnes, where we were talking about owing interest, and there was a quick question here. So borrowers will owe interest even if they receive 100% forgiveness?
As far as what's out there right now, yes.
Okay.
So businesses are going to be encouraged to basically apply for forgiveness sooner than later. You have to wait, I believe, for the first 8 weeks. Once you're past that 8 weeks, then you can go ahead and apply for forgiveness, and the banks have 60 days to get back to you on whether or not they grant you the forgiveness. But until then, as far as what's out there right now, yes, interest does continue to accrue.
Yep. And Jeff, the reason for that is that in the act, it says that the maximum amount of forgiveness is the loan you received. So the interest is obviously on top of the loan. So if you can only get the loan proceeds removed or forgiven, then the interest is going to be on top of that.
Got it.
Right.
Okay.
Also, for documentation purposes, a separate account for your loan proceeds is advisable. It's preferable. It's not required, though. The loan proceeds should be recorded as a liability on the company's books. And then as the reduction in the loan comes in the form of forgiveness, you would basically eliminate that loan at that time. Another idea is, just for documentation purposes, is to set up separate expense accounts for the expenses that you are intending to pay for PPP forgiveness purposes. So for example, if you have a wage account or a rent account on your P&L, so you could set up a separate rent or wage account, maybe wage PPP or rent-PPP, something to denote that those expenses that are hitting those accounts are meant to be used for PPP loan forgiveness purposes, and they're meant to be used for PPP expenses. Here's an example of the journal entries that would be hitting your general ledger and your accounting records. Initially, you would set up that loan with that first debit to cash and your credit to your liability. Once the expenses are paid, whether it's out of a separate cash account or they're out of the original cash account that you had, you would hit each of those expenses that you're paying with the PPP proceeds. It's just a separate P&L line item. It shouldn't be too big of a change to make those adjustments to how you normally record the expenses. And then once the loan is forgiven, currently the law states that the loan itself is not taxable. Well, we do not know if the expenses currently are going to be able to be deducted on the taxpayer's tax returns, meaning yes, the loan income itself is, or the loan forgiveness itself is not income to the company, but if the business can't take those expenses that it was paying with the PPP proceeds as a tax deduction, then in essence, the loan almost becomes taxable. And there's two different journal entries here. One of them is depending on further guidance, is if we can use those expenses as a tax deduction, then what you want to do is basically make sure that the loan forgiveness is hitting an other income line item versus the expenses that you're using to pay out with the PPP proceeds. And that's option one. So if you book option one on the spreadsheet over here, then that will eliminate your loan balance and I'll pull the income to your profit and loss statement, which is the proper way to show it, which will be a difference between book and tax for tax reporting purposes. For tax, you're not going to report the income, but for book purposes, you have to report that income. Option two is if these expenses will not be considered deductible expenses to the company, you might want to consider eliminating the loan against those expense accounts. So when you do that, then what you're left with is the loan is not on your books, but also the expenses that those proceeds were used for will also not be on your books.
Well, I can tell you that I'm getting a lot of notes back thanking you with hearts and clappings because so many people just don't get this basic accounting thing. So here, everybody, is your Cliff Notes and Monarch Notes on how to do it. And the nicest thing is you're going to have a recording of exactly what you just said, probably by tomorrow. So next one.
Jeff, before we move on, one of the reasons that we suggest you had a separate bank account is simply if you are going to be required to submit your bank records as proof, you may not want to be submitting, your bank records for your entire business activity to the Treasury Department. But if you can limit it to only your PPP loan activity, I think that would make us all feel more comfortable.
I totally agree with you.
Absolutely.
Okay.
So as we mentioned, as of right now, the way that the law stands is the expenses that you are using to pay with the PPP proceeds are not deductible expenses. There is a bill out there to make that deductible expenses, at least for smaller businesses. So hopefully that goes through, but as of right now, that has not passed yet. So we do need to plan to make sure that there are funds to pay the tax effect of this PPP loan.
Okay. Okay, so I'm going to just jump in here with a polling question. So everybody, if you would bear with me, I'm going to go right to this. And the question is, how have you been impacted by COVID-19? So of course the questions are: no impact, I'm hurt, but funds will get us through; not sufficient enough funding, we're reducing the workforce with reduced revenue; and I'm closing my doors. And there are well over 100 of you out there that are participating in this, which is really just a great testament to your need for information, and we are providing it just in time. So I'm thrilled that we're having this webinar right now. So we have roughly 65% of you. We've got another 10 seconds that we're going to let you answer. And so far, interesting, 1% of you says you're closing your doors. Sadly, but that is an excellent point there that so few of you are affected to that extreme. But 69% of you said that, you know, you're hurting, but funds are going to get you through. And I think that is great promise. Everybody is now starting to talk about a V-shaped rebound. I mean, of course, there's back and forth, but I would love to see that happen, and so many more of you coming out of this more quickly. There's no impact. 17% of you said this, which is really fascinating. And then 13% of you said not sufficient enough funding, reducing workforce with reduced revenue. So I think, Jed, this sets up the next piece, which you're going to address, on what's the impact if part of the loan is not forgiven. And you're going to go through this detailed example, and I'm going to ask all of you to follow this. We've got a lot of slides coming here, and hopefully some of the questions that were asked in the chat box and the Q&A will be addressed, but we're going to try to hit those questions once Jed is done with this, one at a time. So hang with us. All right, Jed, you're next.
Yeah, so this is a very, very simple example, but I thought it would be useful to go from A to Z on the PPP loan process. So the facts for this example are that you calculated your PPP loan on your 2019 payroll cost. You have a semi-monthly pay on the 15th and last day of the month. Your loan was fully funded on April 27th of 2020. Employees B salary was reduced to $63,000 effective April 1st and restored on June 1st. Employees D and E salaries were reduced to $52,000 effective April 1st and restored on June 1st. Employee G was furloughed on April 1st, rehired at full salary on June 16th, and all employees were full-time during the both the 2/15/19 to 6/30/19, and also from 1/1/2020 to 2/29/2020. So first of all, how do we calculate the amount of loan, which is something everybody's already done, so I'll go through this quickly, but basically you can't count employees A, C, and F beyond $100,000. We get to include everybody else's salary at full salary. So our available total salaries is $599,000. Our average is $49,917. Plus we can add on what they define as other payroll costs, which is our health insurance premiums, or 401k match in this case, but it could be any retirement matching, plus our Florida reemployment tax. So our total base for the loan was $55,417. 2.5 months of that gives us a maximum loan of $138,542. So the first thing we do is we calculate, how did we spend the money? So the first thing is we have our pay periods. Remember that we got our money on the 27th of April, and we're assuming a cash basis in this calculation. So we had a payroll on April 30th, May 15th, May 31st, June 15th. And then notice what I did on the last one is I'm having that payroll on the 22nd, not the 30th. Because if I have my payroll on my normal date, which is the 30th, it would be outside that 8-week period. So I may fail on the, or they may not be included in my forgiveness amount. And as Agnes said, we are still unclear on whether a cash or accrual basis will determine when and how much can be deducted during that 8-week period. But in this case, we're assuming a cash basis, so we had to push our payroll date up to be within the 8-week covered period. So we have in this example, we have $100,000 approximately of covered salary. And then we had our other expenses, which we had rent, we had health insurance, we had a 401k match, we had utilities and interest for another $31,000. So we have expended on qualifying expenses $131,232. So we know that's the top line forgivable amount. So we're going to have obviously some amount we're going to have to pay back because we were not able to spend the full amount on qualifying expenses. So the next thing you do is once you know what your maximum forgivable amount is, the next test is our FTE test. And that, again, is a measurement by month, by pay period within those months. So for our April 30th pay period, we have 6 of the 7 employees that we had during the denominator period still at full time. So we have 6 full-time employees for our April 30th pay period. The same for May 15th and May 31st and June 15th. Now come June 30th, we've hired back the other person, so our full-time equivalence is now 7. And again, it's per pay period per month. So we would then determine what is our FTEs per month on average. So in April, we have 6 for that pay period. We have 1 pay period, so 6 is the answer. For May, we have 2 pay periods, 6 each, so 6 plus 6 divided by 2 pay periods gives us 6 full-time equivalents for May. And for June, we have 6 plus 7 divided by 2 gives us 6.5 equivalents for June. You add those together, divide by the number of months, and now we have a FTE equivalent of 6.17. Our base period is 7 full-time equivalents. So we're down by 0.88 full-time equivalents. If you multiply that by the loan forgiveness, now we can only deduct 115,000, or only have forgiven 115,609 of the loan. So that's the second cut on the forgivable amount. The next one is, do we have anybody that we paid less than 75% during the covered period? And this is the same example that we looked at earlier in the presentation. So you can see that employee G did not earn his full 75%. So we have to reduce our loan forgivable amount by his reduction, which was $1,571. So now our forgivable amount is down to $114,038. And then lastly, the Treasury put into the Act the requirement that 75% of all qualifying expenses are expended on salaries or payroll costs. So that's our final test. So in our case, we had loan proceeds on salaries expended of $100,232. Our PPP loan amount of 126. So we were above the 80%, and I apologize, this should be reversed, that we should have been below the 80% in this example by 5%. So another 5% of my forgivable amount is reduced. So at the end of the calculation, we really have about $109,000 of forgivable amount. So this quick example just shows you that how complex the forgivable amount calculation is that there's 4 levels of calculations that everyone will need to go through before they really know what forgivable amount will be for their loan. And it's a mathematical nightmare. And but hopefully treasurer to give us some clarity on all this.
Well, you know, the great thing is that we have a great group of experts, of course, here on this webinar, but we have a fantastic staff in our office that has been hard at work addressing so many of these issues. There are literally dozens of questions, and I'm gonna try to hit these folks one at a time and see how we do. We are at 145, and as I mentioned at the beginning, we are going to go longer if you folks want to stay on, because we're going to try to hit as many of these questions as possible. But the first one I am going to throw out, you know, Ray had sent out a note saying, and he deals with many CEOs here in Florida, you know, the issue is not so much compliance with the guidelines, but the ability to show the need for the money. So, for example, if you have lines of credit, cash at a bank, retained earnings, et cetera, that show you continue to operate and retain employees without PPP, what is the impact here? Okay, because again, here, I would even think, you know, it's not so much what it is like right now, it's are people going to be paying you in the foreseeable future, which will affect your cash flow. But this is the main issue here of what if I don't really have the need right now, but yet I could be affected in the not too distant future. So Jed or Agnes, you want to take a stab at that?
Well, I think the key there is that we don't know, and I'm pretty confident we do not know what the final forgiveness formula will be. If you all remember signing your loan application, you did state under oath that your business was impacted by the economic shutdown. And that is why you need those funds. Currently in the law, there is nothing that says if your revenues changed at all or went up, went down, has an effect on the forgivable amount. But I gotta believe that based on that one statement that we all said yes to, if at the end of this process, if your revenue hasn't changed and your economic impact was not very much from the shutdown, they're gonna ask for your money back. So the one caution that I would have to everybody is be very prudent with these funds. And until you get through your forgiveness process and the SBA checks off on it, hold on to those funds. Don't go buy a new fishing boat or a new fancy car thinking you made a windfall, because there's good chance that if you were not impacted, they're going to ask for the money back.
Okay, excellent. I'm just going to go back to the interest due on the loan. Here's a question from a client, Jed. If you borrow 1.9 million and you get 100% loan forgiveness, do you still owe 19,000, which is 1% of the total loan?
Yes.
Okay.
Well, whatever that 19,000 is for the period that you borrowed it. So the assumption would be, and we don't know the guidance yet, does the interest run from the date of funding to the date that you have officially been given forgiveness for the loan? Or is it from the day of funding through the end of your 8-week period? We don't know yet, but there definitely will be an interest obligation that needs to be repaid.
Got it. You know, if you have, and I'm going to just bounce around here, and of course Agnes and Jed just speak freely. What if you have 3 pay periods in May? What's the effect?
Well, the effect is.
Yes. Go ahead, Agnes. Of course, ladies first.
The effect is kind of what we went through in the example. Is the pay periods aren't necessarily what the issue is. It's, well, you have to take the pay in that period, annualize it to make sure nobody's getting over the $100,000 limit. But other than that, the impact is really what we discussed. If we don't know if the expenses have to be incurred in that period in order for them to be forgiven or not. So you can add an extra pay period if you need to make sure you get your pay in within those 8 weeks. But the pay period number shouldn't really matter at all.
Got it. Okay. Trish is asking, we had an employee we hired in February 2020 and was just at 30 days in the 90-day probationary status when we closed. Do we have to bring her back in order to maintain forgiveness?
It depends on what denominator you want to use, meaning that if you are better off using as your denominator the prior year from February 15th of 19 through June 30th of 19, then the answer is no. If you're better off using the 1/1/20 to 2/29/20 period, and she was an employee at that time, then the answer is probably yes. You have to bring on someone. It doesn't have to necessarily be that employee.
Got it. Well, Agnes, you were reviewing expenses earlier on, and there's a question about internet. What about telephone? Does that count? I think there was a couple of others here that
Yeah.
I was asking. Okay, good. How about if we pay 100% of short-term and long-term insurance? Can that be included?
That was not part of the payroll cost. The expenses are very specific with what is included for forgivable. It's literally just, the rent, the utilities, the interest, and payroll costs. The disability is not part of payroll costs typically. It's just the health insurance, vision, and dental.
Okay, so
Until
then
we have further guidance saying anything otherwise, that's kind of where we're at.
got it. So just in the area of compensation, are you able to use a PPP to give bonuses and raises during the period?
If it's within the normal business practices, then yes.
Okay, got it. I see Heather is asking, can I process 2 payrolls rather quickly to meet the 8-week deadline? Jed, I think you were addressing some of that.
Yeah, I think that we'll have to do it to hit the 8-week deadline if we're on a cash basis. So yes.
Got it. Good
which
deal.
you probably want to have a conversation with your payroll processing team or outsourced company to ensure that they're equipped to do that for you.
Got it. Well, Dean is asking, if you hire new employees, can they be counted toward the forgivable amount?
Yes,
Yes.
It doesn't have to be the same employees. It just has to be the same equivalent number.
So of
yes.
course, of course, the next follow-on question to some of our from some of our family businesses, do we have to hire the same people that were on payroll before furlough, or can it be new people, even my family members? And will that count?
It can be new people. It does not have to be the same individuals. With family members, just keep in mind that there has to be a business purpose and they have to be able to complete a job. So it has to be reasonable still.
Got it. All right, so here, Kenny's asking, do we have to make sure people are hired for the whole 8 weeks, or can just be hired by June 30th of 2020 and we pay them a large bonus that keeps the pay under $100,000 pro rata for the 8-week period? Is that okay?
That's the question we don't know. If you read the rules literally, the answer may be yes, is that as long as you bring back your full workforce and pay them at their previous wage for maybe even 1 day before June 30th, it seems to say that you're okay. But everything I've read, everyone is cautioning us on not believing that will be the final regulation, that they'll have some change to that one line item because of the fact of it does allow games to be played with your staffing and your employment.
Got it. Agnes, Cliff and Alan are asking about telephone landlines versus cell phones. Are both covered as an eligible expense?
Yes, they should be covered. They both should be covered. They need to be expenses of the company. If you're on a reimbursement plan for your employees, the plan has to be in place before February 15th, 2020. So we haven't gotten any further guidance to say that that's not the case. As long as you had the plan beforehand and you were either expensing cell phones through the company or through an employee, direct reimbursement, both should be covered as long as you can substantiate the expenses.
Okay, got it, got it. Let's see here. So borrowers, I think, Janine, I think we answered this. So borrowers will owe interest even if they receive 100% forgiveness.
Yes, that's correct.
Okay, got it. All right, and I'm just typing in the yes answer, okay. Interest begins on the funding date is the question, so we need to pay back the amount not covered under forgiveness plus 1% of the total loan per month. Is that the fact?
Yes, it starts on the funding date.
Yes, okay. And then we have another one here. Question from someone here about full-time equivalents. If someone is not getting paid in a period but an active employee, in this case, he's out injured with no PTO available, are they not counted towards headcount?
They would not be because they're not on your payroll.
Okay. All right. And so let me keep on going here. Many of the workers on payroll in 2019 and the docs used to get the loan, in this case, have left us since then. Long ago, they said, in fact. How do I get forgiveness for the new employees?
You still have to meet the same test. So you still have to have the full-time equivalents, which means you can replace them either with new folks, if that's your choice, or you have to be able to document that those people that you either laid off or furloughed or whatnot are refusing to come back to work. So that has to be written documentation for that if that's the option that you're choosing.
Got it. Good deal. Let's see here. Could you prepay rent to maximize the forgivable amount?
No.
That is the unknown question right now.
No, but you know, the law is written that it, as Agnes said, that it has to be both incurred and paid during the 8-week period. I'm pretty confident that they're not going to let you prepay rent like for the month of July and take that because it definitely was not an expense incurred in the 8-week period, assuming you got your loan before May 1st.
Okay, let's see here. I'm going down further. For lease forgiveness, Christopher is asking, does this include personal property leases like printers and other equipment? What about storage unit rentals?
Yes, as long as, again, the loan had to be in place or rent had to be in place prior to February 15th, 2020. Right now, there's nothing specifying that it can't be on tangible and real property.
Okay.
Everything goes right now.
Good deal. We have a triple net lease. Ed is asking this. We won't typically pay all parts of the lease, for example, insurance during the 8 weeks. What is the best way to handle that?
Well, I
To be
think,
paid and incurred.
yeah. Plus, insurance would not necessarily be a qualifying expense, so I'm not sure it's relevant.
Mm-hmm.
Got it. So here's another one. We let a manager go on March 31. As the owner, I am now acting as that manager. Can I pay myself for that job?
Yes, but remember, you got to stay under the $100,000 annualized amount in order for it to be a forgivable salary.
All right, good deal. Good deal. All right. Here, JR is asking, employee was paid during the state shutdown. However, now that the state is opening back up, this employee is stating they are sick with a fever. Are we allowed to let them go if in fact they do not provide a doctor's note? And how will that affect the PPP loan for payroll?
I don't know the answer for whether you can let them go. I think that's a labor attorney answer, but if you provide them the opportunity to return to their same job, same duty at the same pay, and they refuse to do so, then you need to document that and they will count towards your FTE calculation. You still got to spend the salary money on someone or somebody, but they will not reduce your FTE calculation if you've offered them the job back and they refuse to come.
Got it. Are vacation hours, Christina's asking this, counted toward the FTE calculation?
Yes.
Yes.
Okay, cool. Let's see here. I'm just going to move back. There's so many here. Let's see here. I got that one. All right. So how are overtime hours calculated for FTE purposes?
You ignore them because of the fact that for the calculation of FTE, you can't have more than 30 hours per employee. So once that employee hits the full-time equivalent of 30 hours, you don't count their hours any longer.
Okay. All right. Let's see here. Okay.
We do have a question on there about PEOs. Just want to make sure we address that.
Yes, go ahead. Ask that question. Go ahead.
The wages that you're paying through a PEO do count towards your wages as the business, not the PEOs. The PEOs is responsible for making sure that you do get documentation on how much of the pay is for wages, how much is for Social Security and insurance and any other costs. So yes, those do count. You need to make sure that you get proper documentation from the PEO, not only of what their breakout is of the expenses, but then on your side as the business, you need to be able to show that you did pay the PEO.
Okay, great stuff. Here is a scenario. If your pre-loan employee count was 10, can you hire additional employees, let's say 15 employees now, and pay them with the PPP loan?
Yes. There's no limit to who you can hire and pay. It doesn't have to be the same employees. You just have to spend the money on payroll costs.
Got it. Debbie's asking, we had an existing SBA loan and the bank notified us that the SBA was going to make our payments for the next 6 months. We never asked for this. So how are these payments going to be treated?
Not sure. Agnes, do you have an answer? But I would assume that they will be mutually exclusive from the PPP calculation, meaning that.
Right, and I'm not quite clear on that one. Is it that they deferred the payments, or is it that they're forgiving the payments?
Not exactly sure here.
Okay.
Not exactly sure.
We can
All
try
right.
to see what we can find on it and answer later on offline.
Here's an interesting question from a person near and dear to all of our hearts. Can I convert my independent contractors to employees? Why or why not?
Yes, you can.
Okay.
Yes, you can.
All right. And that would be during the term period here. Okay. All right. Let's see here.
Just keep in mind that those independent contractors may have also applied for PPP loans on their own. So that's something you may want to mention to them is that might affect them individually. You don't know. But
Okay,
that's not an issue for the business. But the business can hire whoever it wants to hire. Just need to keep the FP, the full-time equivalent count up, and then the payroll amount up.
Okay, so here Andrew's asking that Agnes stated that SUTA was considered forgivable. What about FICA, FUTA, work comp costs, EPLI, payroll processing through PEO? No.
None of those. Right. It just specifically states that state payroll expenses are forgivable.
Got it.
So that's just the one specific item, and it's just SUTA for Florida.
Good deal. All right. Of course, we are just passing the 2 o'clock hour. We're just going to try to knock out a few more of these. So thank you for staying with us. So here, can PTO and vacation pay count? Jane is asking that.
Absolutely.
Yes. All right. Good deal. All right. So my rent was due 5/1, not paid until 5/8. When funds received, do I have to prorate for the 8 days? Trisha's asking that.
The answer is we don't know. I would assume not. You know, it goes back to, is it an accrual or a cash basis? So hopefully we'll get better guidance. If you take the literal interpretation, the 7 of the days were not incurred during the 8-week covered period. So on a technical answer, the answer is you would have to prorate, but we really don't know the final answer until we get more guidance from the Treasury.
Got it. Georgette was asking, our pay period ran from April 16th to April 30th. We received our PPP funds on April 23rd. What is forgivable? The entire payroll paid on 4/30 or only the amounts earned by employees between April 23rd and April 30th?
The same answer. I mean, the literal interpretation would mean that only from, April 30th, April 23rd through the 30th. But what I've read is most people are leaning towards more of a cash basis. So the fact that the cash was expended on April 30th, the entire payroll would be included in the forgivable amount.
Okay, got it. Let's just see here. There's so many of them, and we are at the 2:05 hour. I think we might try to do one more here. Let me see what makes sense to ask here. Okay. When we calculated, this is Debbie asking, when we calculated the amount of payroll for the 2.5-month average, we took the 2019 numbers, which included quarterly bonuses. The 2.5-month or 8-week period that we are now using to calculate the amount eligible for forgiveness will not include a quarterly bonus payroll. Can we pay our quarterly bonuses early to have the amount used in the forgiveness calculation?
The answer is we're not sure. Again, the language that I've read about bonuses just says that if you pay a bonus normally during that period of the covered period, then you can pay the bonus and take the deduction. If you're trying to cram in a bonus into a period where you normally do not pay bonuses, the language is very unclear on whether that would be a deductible or includable payroll cost.
Got it.
Yeah, we're hoping for more clearer guidance on that issue.
Okay, and then the last one, I think you had asked, actually, Agnes, you had mentioned this as far as tax implications. Carolyn had heard that salaries and expenses paid with PPP funds won't be considered valid deductions. Can you speak to that?
As of right now, that is correct. They are not valid deductions, but right now there is a bill going through that could change that for small businesses. So we'll see.
Got it. All right. So here we are. We are at, boy, I tell you that the time flies when you're having fun, but we are at the time of closing, and it's time to say until next time. But here we're going to have the contact information of our team on the next slide. But just know what I had said earlier, that a follow-up email is going to be sent to you after the webinar. And actually, as you exit this webinar, you'll have an opportunity to do an experience survey. It takes about 30 seconds. Would really appreciate your feedback. But you'll be getting a video recording and the PowerPoint in an email tomorrow. Also, as I mentioned, that we're going to take all of these questions and have a Q&A document, and over the next several days, the latest a week, we'll have these in writing as to the best of our ability. As I mentioned, our subject matter experts will be on call for anything that was not addressed, and we're going to be hosting a few of these every single month. As you know, we have been doing things weekly for the last 7 weeks, and we have enjoyed serving you. Here is our contact information, and please do take advantage of that. And first, and lastly, I'd like to thank Jed and Agnes. I mean, this has been crazy times. You can't imagine the amount of time we're spending speaking with clients, and these two people literally taking 2 hours out of their day to do this and pull this all together. First of all, I want to thank you for the time that you took. I know our clients and friends truly appreciate it. And also, you know, just the feedback we've been getting has been fantastic of all this timely information. So I want to thank you guys for being today's subject matter experts. And then I'd like to thank your audience. I mean, our audience here. There were 107 of you that were on this call. We thank you for your time and engagement here. And until next time, I'm Geoffrey Gallo. We're done, and stay well. Thank you.
Thank you.
Thank you. Take care.
Hello.
Just us?
I will tell you in a second.
Wow. That was a lot of questions on that.
There's still a bunch.
Watching the Q&A go through, woo,
Yeah.
trying to answer some of them as we're going along, but wow, there's a lot.